My name is Derek Brown. I'm the Senior Portfolio Manager of the National Bank Corporate Bond Fund and the National Bank High Yield Bond Fund. So far it's been a pretty good year for bonds with rates moving lower over the last course of 9 months. We do think that this is coming to an end and most likely rates will go higher going forward. And what this means really is that you want to be moving more towards credit assets, so investment grade corporate bonds or even high yield bonds, as they tend to perform better when interest rates move higher. We don't actually believe interest rates are going to go up dramatically higher. We do expect US 10-years probably to get somewhere around 3.3 to 3.4% by the end of 2015. So while rates will be going higher, we don't believe they'll be dramatically so. So we actually think this is a really positive environment for credit in general. Investment grade bonds will do quite well during this type of environment, and high yield bonds especially. Historically speaking, high yield bonds actually dramatically outperform during periods of rising interest rates, and that's why we think clients, in an expanding economic environment, we do believe that clients should be overweighting high yield at this point. As interest rates do rise, there will be volatile moments for the high yield market in general. We saw one in June 2013 when the market fell by 3%, and we saw another one in July of 2014 when the market fell by 1.5%. In both circumstances, the market rallied aggressively in the following months after that sell-off. And the problem with ETFs, they can't actively manage during those period of time, so they can't move to a higher cash position or eliminate CCC bonds that will perform worse during a sell-off. Whereas actively managed portfolios can generally take advantage of these type of temporary sell-offs and can add value over the long term. So while credit spreads are quite low based on historical standards, we still haven't reached the lows that we saw between 2004 and 2007. And once we reached those levels back in 2003, we stayed there for several years. We do expect credit spreads to tighten again over the next year or two. And it won't be until the yield curve in the United States and Canada moves to a flattening type position where the overnight rate, the 2-year rate, 5-year rate, and 10-year rate are all roughly the same level, that becomes dangerous for corporate bond spreads, because that generally signals the next recession. So we don't believe that'll happen until probably late 2017 or even into 2018. So we do think we have several years left of a good carry environment for corporate bonds. We do generally believe that high yield bonds are misunderstood by the vast majority of investors out there. Historically they were known as junk bonds, but if you actually look at what makes up the high yield bond index, you're looking at major corporations such as General Motors, Ford used to be involved there, Bombardier. These are large corporations, Air Canada. So we do feel there's a lot of value in these large corporations. And if you do look at it over the last 20 years, high yield bonds are actually the second best performing asset class after emerging market equities. And even on a risk-adjusted level, they're significantly superior on a Sharpe ratio to the S&P 500, to leveraged loans, and even actually to federal bonds. So on a risk-adjusted return level, once you factor in the risk you're taking and the performance, high yield bonds are quite attractive, and we do believe it should be a core holding for all portfolios.